All right, welcome to Iron Financial. Our mission here is simple. We cut through the market noise to find out what's forged from steel and what's just fool's gold. And today, wow, we have got a live one. EQT Corporation just dropped a fourth quarter earnings report that can only be described as a total, complete blowout. Now, the numbers look staggering, but our job is to look past those shiny headlines and really dissect the structure. So is this company actually building a fortress, or is it a house of cards just waiting for a strong wind? Let's dig in. And we're going to start right here with the one number that made everyone snap to attention, a 46.6% year-over-year revenue growth. Look, in this market, and especially in this sector, that is not just growth. That is an absolute explosion. It's the kind of top-line number that makes you stop, lean in, and ask, what on earth is going on under the hood at this company? Is this real and sustainable, or is it just some one-time fluke? That's what we're here to find out.
You know, that headline number is really just the beginning. Today, we're putting EQT through the full Iron Financial stress test. First up, our lead analyst is going to build the bull case, piece by piece, starting with those unbelievable Q4 numbers. Then we'll get into the foundation, how they're taming their debt, and we'll look at their actual blueprint for 2026. After he's built this perfect picture, I'm going to step in. As the skeptic, I'm going to look for every single crack in the armor. And we'll finish up by weighing both sides to give you our final verdict.
Okay, let's start building, and there's only one place to begin, with the hard evidence from that fourth quarter report. And listen, we're not talking about one good data point here. We are talking about a cascade of proof, a tidal wave of numbers that all point in one direction. This is a company operating at an incredibly high level. This is the bedrock of the entire bull argument, so pay very close attention.
Okay, just look at this. I mean, come on. This isn't just a beat. This is an absolute demolition of expectations. Wall Street, the so-called experts, they were modeling for adjusted earnings per share somewhere in the mid-70-cent range. EQT comes in and drops 90 cents on the table. 90! That's not even in the same zip code as the estimates. Then you look at revenue. The analysts were hoping for what, $2.1 billion? EQT comes over the top at almost $2.4 billion. They didn't just clear the bar here, they launched the bar into orbit. This tells you one thing, and it's absolutely crucial. The market's models fundamentally misunderstood the operational power this company had in Q4.
So what's really fascinating here is just the raw scale of this jump. We're not looking at some tiny incremental gain. A year ago, Q4 2024, they posted revenue of $1.62 billion. This year, $2.39 billion. That's almost $800 million in additional revenue in a single year-over-year quarter. This is how you visualize that 46.6% growth we started with. It shows this powerful, undeniable momentum. This is not a company that's just treading water. This is a company with its foot slammed down on the accelerator.
So you have to ask, where is this coming from? Are they just getting lucky with gas prices? Nope. This slide right here shows you the nuts and bolts. This is the real work being done in the field. They sold more gas than they promised, exceeding the high end of their own guidance. And get this, while they were producing more, they actually spent less money to do it, coming in 4% below their capital spending midpoint. Just think about that for a second. Higher output for lower cost. It's the holy grail. Their well costs are down a massive 13% from the year before. And when Winter Storm Fern hit and everyone else was scrambling, their uptime was 2 times better than their peers. This is not financial engineering, folks. This is real-world operational dominance.
So what does all that excellence on the ground translate to? What's the bottom line? Well, here it is, a mountain of cash. $744 million in free cash flow in a single quarter. This is the ultimate health metric for any company. After you've paid all your bills, after you've made all your capital investments, this is the cash that's left over. It's the lifeblood. It's what you use to pay down debt, to invest in growth, to give back to shareholders. And generating almost $750 million in free cash in just 90 days, that is the sign of a machine that is running white hot.
And hey, you don't have to just take my word for it. Let's look at the words from the CEO himself, Toby Rice. Quote, outstanding performance across the board. He's confirming everything we just laid out. Exceeded production, hit record low costs, and came in under budget. He's basically handing investors the report card, and it's covered in A+. This just puts a capstone on the Q4 performance. The machine is firing on all cylinders. Period.
But listen, a great quarter is just that, one quarter. A truly strong company. A company that gets the Iron Financial seal of approval takes that success and immediately uses it to forge a stronger foundation. They use the good times to bulletproof themselves for the bad. And for EQT, that means one thing above everything else, taming the gigantic debt load they've been carrying for years. This next part isn't about short-term performance, it's about building a rock-solid, resilient balance sheet for the long haul.
And this slide,
This is the whole ballgame. For me, this is the most critical part of the entire bull case. This is their blueprint for forging true financial strength. Just follow the path. At the end of 2024, they were shackled to a massive $9.1 billion anchor of net debt. I mean, a huge, huge number. By the end of 25, they'd chipped away at it, getting down to about $7.7 billion. But now the real assault begins. The target for this quarter is to get under $6 billion. And by the end of 2026, they're aiming for around $4.7 billion. You have to understand what this means. We're talking about cutting your debt in half in 2 years. That's not just cleaning house, it's a complete teardown and rebuild of their financial structure. And let me be perfectly clear why this is so damn important. When you slash your net debt from over $9 billion down to a target of $4.7 billion, you fundamentally change the DNA of the company. Think about it. Every $1 billion of debt you wipe off the books means millions and millions in interest payments that you no longer have to make year after year after year. That cash goes straight back into the company's war chest. It radically lowers your risk profile. Bondholders love you, shareholders feel safer. And most importantly, it frees up billions in future cash flow that would have been burned servicing debt. Now that cash can be deployed for smart, high-return growth projects or returned directly to shareholders. This isn't just about accounting. It's about building a company that is far more resilient, far more flexible, and ready to weather any storm the energy market throws at it. This is the heavy lifting.
So once you've reinforced that foundation, what do? You start building on top of it. You execute a growth plan. With that balance sheet being rapidly repaired, EQT is now laying out a crystal-clear strategy for 2026 that leverages all of their new financial firepower. Let's see how this builds. And this table perfectly illustrates their two-pronged attack. Just look at the numbers. First, they're committing over $2 billion to maintenance capital expenditure. That's the cash you need just to keep the current machine humming, to maintain that massive sales volume. But then, look at the next line item, nearly $600 million specifically for growth CapEx. This isn't about standing still, this is about surging forward. This is for infrastructure-focused projects designed to generate high returns. And here's the kicker. Even after spending all that money, both for maintenance and for growth, they are still projecting to generate a colossal $3.5 billion in free cash flow for the year. That's the power of their efficiency combined with that strengthening balance sheet.
Now look, any plan that just relies on hoping for high gas prices is a weak plan. And you can tell management knows this. That's why this move is so smart and so important. They have strategically increased their 2026 hedge position from just 7% all the way up to 25%. So what does that mean in plain English? It means they've already locked in a floor price of nearly $4 for a quarter of their production. This is a prudent defensive move. It's like buying insurance on your future cash flow. It protects the entire plan we've just talked about, the debt paydown, the growth spending, all of it. It proves they aren't just betting on blue skies, they're preparing for rain. That is the sign of a disciplined, mature management team.
All right, I have to admit, the lead analyst has built a very impressive-looking fortress here. Record performance, a mountain of cash, a clear plan to slay the debt monster. It sounds almost too good to be true. And that, right there, is exactly when my alarm bells start screaming. A story this perfect usually has a chapter that's been ripped out. So now, it's my turn. We're going to take this beautiful structure that he's built, and we are going to stress test it. We're going to look for the hairline fractures, the weak points, the cracks in the armor that could bring the whole thing tumbling down.
So let's just start with the most basic, most fundamental question of all. These unbelievable projections, $3.5 billion in free cash flow, getting net debt down to $4.7 billion. Where do these numbers actually come from? Because forecasts are not guarantees. They are nothing more than a set of assumptions piled on top of each other. And as any investor who's been around the block knows, assumptions can be incredibly fragile. So the big question I'm asking for every single cautious person watching is this: how reliable are the assumptions that this entire bull case is built on?
Let's get specific. Let's name the red flags I'm seeing. First and foremost, pricing risk. It's the elephant in the room. Their own documents admit that these amazing forecasts are based on recent strip pricing. That is basically the market's current best guess for future prices. The key word there is guess. Natural gas prices aren't stable, they are violently volatile. If prices collapse, that $3.5 billion cash flow projection goes up in smoke. Poof, gone. Second, there's a direct warning from a professional service, Guru Focus, flagging potential liquidity constraints. You can't just brush that off. Third, I really have to question spending $600 million on growth projects right now.
In a market this jumpy, wouldn't it be smarter to use every last dollar to crush debt even faster, or just give it back to shareholders? And finally, let's just remember the neighborhood we're in. The natural gas sector is, and always has been, notoriously unpredictable. Booms are always followed by busts. It is the nature of the beast.
And I want to drill down on this point because it's a big deal. The Guru Focus Report, which is a service designed for deep financial analysis, uses the specific phrase, investors should remain vigilant. Look, that is not something you say about a company that's a slam dunk. It's a professional warning sign. It suggests that despite all the shiny revenue and earnings numbers, their analysts see something in the underlying financial plumbing. Maybe it's the timing of cash flows versus when debt payments are due that makes them cautious. So is the bull case just so caught up in the excitement over operational wins that it's completely ignoring a critical risk factor that a third-party expert has pointed out? It's a question we absolutely have to ask.
Okay, so we've heard both sides of the argument. You have the bull case, built on a foundation of incredible operational execution and a super aggressive plan to fortify the balance sheet. And then you have the bear case, which really hinges on the fragility of forecasts, external market risk, and that specific liquidity warning. Now it is time to put it all together, to weigh the evidence, and to deliver the iron financial verdict.
This slide really lays out the whole conflict perfectly. The lead analyst's bull case is that fortress on the left. You've got the record numbers, the massive cash flow, and that clear plan to kill the debt monster. It's an argument that's all about internal strength. On the other side, the bear case on the right is like a giant tidal wave of external risk. It's the argument that the entire beautiful forecast hinges on volatile gas prices that EQT can't control, that a third party has flagged a liquidity risk, and that the sector itself is just a minefield. So the whole debate comes down to this. Is EQT's internal strength enough to overcome these huge external risks? And that's exactly where my conviction comes from. The skeptic is 100% right to point out these risks. They are absolutely real. The natural gas market can turn on a dime, and you cannot just dismiss that Guru Focus warning. But my argument is that everything EQT is doing is precisely the work a company should be doing to protect itself against those very risks. Their operational efficiency gives them a lower cost basis, which makes them more resilient if prices fall. The aggressive debt paydown is the definition of building a fortress. It lowers their break-even point and strengthens their ability to survive any downturn. They are using their current strength to build a shield against the exact volatility the skeptic is worried about. And I'll concede the point, the internal work they are doing is textbook. It's really impressive. If this company existed in a vacuum, it would look fantastic. But here's the thing, we don't invest in a vacuum. My point remains that sometimes external forces are just more powerful than any one company's excellence. A tidal wave of collapsing energy prices doesn't care how efficiently you drill your wells or how much debt you've managed to pay down. So the ultimate risk here isn't really that EQT will fail on its own terms, it's that the entire market could turn against them, and no amount of internal fortification can stop a tsunami.
So, here it is, our final unified verdict. EQT presents a really compelling story. It's a case study in how a company can use a period of absolute operational dominance to aggressively fix its biggest historical weakness, which has always been its balance sheet. Now, the external risks that the skeptic brought up are real, and they are serious. The gas market is volatile, and any forecast can be wrong. However, the company is doing all the right heavy lifting to control its own destiny. That plan to nearly halve their net debt in just 2 years is the single most important factor here. So for the disciplined investor who understands the risks of this sector, this looks more like a calculated opportunity than it does a fool's gold trap. The internal strengthening, for now, seems to be outweighing the external threats.
But as always, this is our analysis based on the data we have today. It is absolutely crucial that you take this information, go read the reports for yourself, and forge your own conclusions for your portfolio. Always do your own due diligence.
And we will leave you with this one final thought to chew on. EQT has done a masterful job of building a fortress to protect itself from its own past weaknesses: too much debt, inefficient operations. You could say they've solved for the internal enemy. But the ultimate question for this company and for every investor always remains: in a deeply cyclical and volatile industry, is any single company's fortress, no matter how well built, actually strong enough to withstand the full, unpredictable force of the entire market? That's the question to ponder.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.